Ladies and gentlemen, good day and welcome to Dodla Dairy Limited Q4 FY26 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Dodla Sunil Reddy, Managing Director of Dodla Dairy. Thank you and over to you, sir.
Thank you very much. Good morning to all the participants. On behalf of Dodla Dairy Limited, I extend a very warm welcome to everyone joining us on our call today. On this call, I am joined by our CEO, Mr. B.V.K. Reddy, CFO, Mr. Murali Mohan Raju, and SGA, our Investor Relations Advisors. I hope everyone has had an opportunity to go through the financial results and investor presentation, which have been uploaded on the stock exchanges and our company's website. Now coming to the business, financial year FY26 was a year that tested the dairy industry. Milk supplies remained constrained for most of the year. Procurement cost inflation was sharp, and erratic rainfall affected demand for certain value-added products in some regions. Against that backdrop, Dodla Dairy delivered resilient performance. Revenue growth was 11% year-on-year. EBITDA margin stood at 7.5% and a PAT margin of 6.5%. Notably, the performance is overall on the healthy base of FY25, which delivered an exceptional growth of almost 20 years over the previous. To better understand the trends of the dairy industry, one should look at the 3 to 4 year cycle. On that basis, our 4-year CAGR stands at a healthy level of 16%. Based on our growth and expansion plans for the next 3 to 4 years, we are confident to maintain or even surpass this CAGR number in the long run. The pressures we faced were industry-wide. In such tough times, the diversifications which we have built via Africa and Orgafeed played a critical role. Now coming to the quarter performance. During the quarter, we recorded our highest ever revenue growth for the 4th time in a row with a top line of rupees 1,074 crores, reflecting a year-on-year growth of 18%, primarily driven by volume expansion. The EBITDA for the quarter stood at 5.5% and PAT margin stood at 6.5%. Margins remained under pressure due to elevated milk procurement costs and a calibrated pricing strategy. An increase in procurement price was not fully passed on to the selling price to maintain the market share. Our pricing strategy is in line with the overall industry. Going forward, the situation is turning positive. Milk supply is improving, which should result in a normalization of procurement costs. For milk sales, some price hikes will also be considered. Some trends are already visible, where a few of the northern players have already increased their milk prices. Our value-added product segment witnessed steady performance during the quarter. Due to operational variability, the overall VAP portfolio could not grow to its full potential. Once our planned expansion fully stabilizes, our planned expansion directionally, we are confident that the VAP mix will improve further. This growth will be delivered by curd, paneer, and ice cream, and broadly, we are targeting closer to 32 to 34% in terms of VAP contribution. Africa business recorded a revenue of rupees 151 crores, reflecting a robust growth of 48% year-on-year, driven by more than 60% growth in liquid milk sales. As a result of continuous increase in the scaling of business along with better operational efficiency, we have achieved our highest ever EBITDA number of rupees 18 crores in Africa. And this is for the 4th quarter. The decision that we took 12 years ago to extend our footprint in Africa has now become an important engine for long-term growth of the company. We see Africa scaling towards 15 to 18% of consolidated revenue by FY28, supported by a phase 2 expansion in Uganda, which will include pasteurized milk and milk products that will be sold in Uganda. Orgafeed business delivered a strong revenue growth of 23.2% year-on-year with a slight dip in margin as a factor of higher raw material costs and expansion of our footprint of distribution. This business complements our core dairy operations with a strategic angle. It helps in strengthening farmer relationships through assured feed supply and creating an important loyalty loop in our procurement network. OSAM business reported a steady progress with our focus remaining intact on enhancing operational efficiency in this business to improve profitability. I also would like to welcome Ms. Dodla Reddy, who got appointed by the board as a senior management personnel for strategy and transformation. Silpa has spent considerable time understanding the business across verticals, and now she is increasingly taking responsibility in the strategic and operational areas. Now speaking about the expansion projects. Our Maharashtra project is progressing as per the scheduled timelines and is expected to start commercial operations by the end of FY27. The work is under progress and rupees 106 crores worth of capex has already been deployed cumulatively across 25 and 26. We have also made decent progress towards improving our operational efficiencies of the OSAM business, improved its product quality and upgraded the infrastructure. We should continue in this direction till margins are at par with the overall company level margins. We were also allocated a 7-acre land parcel by the Bihar Industrial Area Development Authority for a dairy project, which will call for additional investment of around 4.4 crores towards the land. The project is presently under consideration and further details shall be disclosed after board approvals. On the Uganda expansion plan, we acquired 70 acres of land parcel for a greenfield expansion. Total capex budgeted for this project is currently around 60 crores, including land as well as the plant. It will be executed in a phased manner and will be completed by year end of 29. Before I hand over to BVK, let me share our directional views for FY27. We expect revenue growth to be in the low to mid-teens, supported by OSAM's full year contribution. Africa continuing on its current trajectory and an 8 to 9% organic growth in our India business. We are expecting a gradual gross margin recovery of 50 to 100 basis points over FY26 levels as procurement normalizes and our pricing actions take effect. Effective tax rate will return to the normal 25 to 27 range post completion of the favorable tax orders we received in FY26. On capital allocation, let me articulate the firm clearly. Our priority order is first fund growth capex, where Maharashtra, Uganda, and our current regular capex are both covered from our internal accruals. Second, regular dividends. Third, selective bolt-on acquisitions where we see procurement or distribution synergies. The combination of strong company fundamentals, a clean balance sheet, healthy cash flows, and all of these growth initiatives underpins our commitment towards a disciplined capital allocation and long-term sustainable growth of the company. With this brief, I will now hand over to our CEO of the company, Mr. BVK Reddy. Thank you very much.
Thank you, Mr. Sunil Reddy. I will now walk you through the consolidated performance highlights of our business. During the quarter, despite a shortage of milk in the overall industry, our milk procurement level remained stable at 18.5 lakh liters per day, which is an increase of 13.4% on a year-on-year basis. Underscoring the strength of our procurement network, long-standing farmer relationship. The average procurement cost in Q4 FY26 stood 31 rupees per liter as against 38.7 per liter in the previous quarter and 37.4 liter Q4 FY25. However, we did not entirely pass on this increase in cost to the consumers. Our average milk sales price for the quarter stood 58.4 per liter, which was 57.7 per liter in the previous quarter. This was primary reason for our margin being under pressure during the quarter. To give some context, our standalone India EBITDA margin for the quarter reflected sharpest quarter of the procurement cost inflation in this cycle. The consolidated EBITDA margin of 5% was supported meaningfully by Africa and Orgafeed, which together delivered around 22 crores EBITDA in Q4. On nine months basis, our standalone India EBITDA margin was approximately 6 to 7%. In Q4, represented cyclical throw, we expect this begin to recover in Q1 FY27. We also witnessed some cost pressure in packing and logistic costs, among other things, due to the shift of bulk sales in higher liquid milk and milk product sales. Speaking of Africa, we continue with our growth momentum in the Kenya market. The business is now seeing the benefits of scale, with profitability improving steadily. We continue to price our products competitively to strengthen market presence and remain confident of gradual improvement in margins. Now coming to our product sales mix. Dodla recorded its highest ever milk sales of 14 lakh liters per day, driven by the continuous efforts of our team towards expanding the geographic reach across India and Africa. Total value-added products stood rupees 2,969 million as against 2,841 million in Q4 FY25. Excluding bulk sales, VAP delivered growth of 21% on year-on-year basis. Curd sales volume reported a healthy growth of 15.4% on year-on-year and stood at 442 million metric tons in terms of value. Curd sales grew by 19.1% on year-on-year basis. Products like curd, paneer, buttermilk, flavored milk, lassi, etc. delivered a recent growth, whereas the other products remained muted due to seasonal variance. Within the Orgafeed business, the revenue growth is healthy and the utilization levels also are scaling up in a good way. However, rising the raw material input costs have not been fully passed on to the farmers. In order to sustain long-term relationship, aim to low milk supply environment, heightened competitively intensity. Some modernization in the input cost is expected in the upcoming quarters, which would improve the profitability of this business. Our pricing strategy in line with the overall industry, and we also see an opportunity to increase milk price in the near terms to pass on some part of elevated procurement cost. We are also witnessing some modernization in procurement costs as the milk supply in the industry is coming back. Hence, we expect a gradual improvement in the margin going ahead. With the strong underlying fundamentals and expansion plans in place, we remain focused on effective execution and achieving long-term objectives while delivering profitability growth. Now, I would request our CFO, Mr. Murali Mohan Raju, to share the financial highlights for the quarter. Thank you.
Thank you, Mr. V.V.K. Reddy, and a very good morning to all the participants on the call. Talking about consolidated financial performance in Q4 FY26. Revenue from operations for Q4 FY26 stood at 1,074 crore, making its highest ever quarterly revenue, growing 18.1% on a year-on-year basis from 910 crore in Q4 FY25. Gross profit stood at 247 crore with a margin of 23%. Employee expenses for the quarter stood at 52 crore, up approximately 27% from FY25, primarily reflecting wholesale inclusion, Maharashtra greenfield expansion, and the Kenya plant ramp-up. Other expenses stood at 141 crore compared to 123 crore in the corresponding quarter last year. While other expenses remained broadly in line with the revenue as a percentage of sales, the increase in absolute terms was primarily driven by increase in infrastructure-related expenses, including rent, employee travel, and the conveyance cost due to an increase in the headcount of the employees. Higher transport costs owing to shift in product mix from bulk sales towards liquid milk and VAP. We reported EBITDA of 54 crores for the quarter with an EBITDA margin of 5%. Depreciation expense increased to 22 crore during the quarter as against 18 crore in the same period last year. Other income for the quarter stood at 20 crore, including 10 crore of interest income tax refund pertaining to interest on a tax refund following a favorable IT-80 order. In Q4, we recorded an exceptional item that is 3 crore worth of reversal on the one-time labor code expenses, which was recorded in Q3 FY26. An exceptional expense of 5.7 crore was recognized in the previous quarter pursuant to the revised labor code guidelines. However, the actual impact was lower than initially estimated due to the restructuring of salary components. Additionally, the company recorded a tax reversal of 29.2 crore for the quarter relating to earlier years following favorable orders received from the ITAT. These tax credits represent the final portion and accordingly no further impact shall be reflected from the next quarter onwards. Net profit for the quarter stood at 70 crore with net profit margin of 6.5%. I want to call out the one-off support to Q4 PAT explicitly. The 70 crore reported Q4 PAT includes 29 crore earlier tax credit, which I just mentioned, and 10 crore of interest income on the related tax refund. Excluding these two one-off items, our Q4 underlying PAT is approximately 40 crore. For the full year, FY26 reported PAT of 267 crore includes total one-off benefits of approximately 70 crore, that is 58.7 crore of earlier tax credit through the year and 10 crore of related interest income. Adjusted FY26 PAT is therefore approximately 215 crore with an adjusted PAT margin of around 5.2%. This is the clean baseline against which FY27 should be evaluated. Now coming to FY26 performance. Revenue from operations grew by 10.9% year on year to the highest ever 4,125 crore compared to 3,720 crore in the previous year. Revenue remained over 1,000 crore for all the quarters of FY26. Gross profit increased by 3.3% year on year to 1,055 crore. EBITDA for the year stood at 309 crore with EBITDA margin at 7.5%. The company reported a profit after tax of 267 crore, translating into a PAT margin of 6.5%. The company generated healthy cash flow from operations of 295 crore during the year, while total cash and cash equivalent stood at 649 crore as of 31st March 2026. This includes cash and bank balance over cash and bank plus our current as well as non-current investment, as all of those are liquid in nature. Our debt to equity remains under control at 0.03 levels. The capital investment done in FY26 is about 430 crore. This includes around 271 crore of expansion capex in HR Food, 86 crores in Maharashtra during FY26, taking the cumulative Maharashtra spend across FY25 and FY26 to 106 crore against a total project envelope of 280 crore, and the balance 73 crore of maintenance capex. For FY26, the board has recommended a final dividend of 5 rupees per equity share. With this, we conclude this presentation and open the floor for further discussion.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Praveen Kumar from Equitas Capital Advisors. Please go ahead.
Hello. Yeah, hi. Thanks for the opportunity. I had a few questions. The first one was Can you give us a sense of what is the steady state margin that we can expect in this current environment? Because earlier in the call, you had specified 50 to 100 basis points improvement, margin improvement from FY26 levels, which would still take you to about 8% at an EBITDA level, 8 or 8.5, which is at the lower end of the earlier margin band which you were referring to. So are you recognizing a structural lowering of the steady state margin that you can achieve, or is it like are you saying that FY27 is a year in transition and then then onwards there are factors which can take it upwards? Yeah, that's my first question.
So thank you very much for the question. I think it's more in terms of being cautious with this whole uncertain environment that we are in, because none of us are able to take sure of what is going to be pricing of fuel, pricing of plastics, the whole agriculture under impact with urea production. None of this is very clear for us. So that is what it's leaving. We'd rather be on the cautious side of taking what can be, what we can achieve even by considering all the uncertainties that are there. So this is more a 27-year kind of a year where, taking into consideration uncertainties, what is going on, that we are trying to give this kind of guidance.
Just as an aside to that, do you see, for example, when you're talking about the urea issues, etc., on one hand, it can indirectly impact your feed business, but on the other hand, if farmers are constrained on the agricultural side of things, they might focus more on the livestock part and might improve on the dairy procurement side, right? So could you throw some light on this?
You are exactly right? If there is drought and less of agriculture, then animal husbandry steps in to acts as a buffer for the farmers to grow. But like I said, we are not too sure where that's going to head, right? Is the El Nino actually going to play out and more procurement pricing coming in? So that is the reason we are being more cautious, because you have a weather which is normally there as an uncertainty, but added to that, the uncertainty of the war and the pricing that is coming. So keeping that into consideration, we are being more cautious.
So to understand you are saying that post FY27, assuming some of these things normalize, you can get back to a more normal kind of...
Yeah, it will come back to the normal, And also one more thing is, like in these uncertain times, right, we have to be very careful of taking care of both the ends of the chain, that is the farmer and the customer. If we go and unreasonably try to kill the customer, then we'll lose not only consumption will start taking a dip. If we are unreasonable with the farmer, long-term impact in terms of productivity also will get it. So keeping both into consideration is why we are being more cautious than being aggressive.
Understood. And on the VAP mix, can you throw some light on how are you trying, what are the steps that you're taking to reduce the seasonality of that? And I think you had already indicated some kind of a mix, stable mix you want to get to. But if you can throw some light on how do you, plan to reduce the seasonality part of it to the extent, because a lot of your existing products in the VAP are somewhat seasonal in nature. So
basically seasonality impacts three major products for us. One is ice cream, which does not move the needle significantly because the smaller portion is the overall. Buttermilk, lassi and curd are the ones which majorly go affect with the seasonality. That I think will be very, it's a southern consumption habit that if there is more summer, people shift more towards the fermented products. We are trying to see that if it becomes a throughout the year product, what was exclusively 2 to 3 months, we are trying to extend that to a 6 months period to see that people start using it as a refreshment rather than worrying about it as a summer product. On the other hand, products like paneer have improved for us. Paneer has seen a significant growth that has come in the local consumption once placements are in place. And also that we are looking at things like our flavored milk, which is also expanding and growing at a bit of a steady state growth that we're looking at growing those products. I think in the days to come, depending on customer habits and health grounds, we will think that even buttermilk and such will become a regular product. Other than that, I think the shift will not be, we will not be able to change customer habits dramatically.
Understood. And the last question was on OSAM. What operational changes incrementally are you driving to converge OSAM margins with overall company margins? And
in detail, the operational margins that we're looking at OSAM. See, basically broadly it's on all fronts, right? It is on production, it's on market, and it's on procurement. I think the operational efficiencies that you're saying, I'll ask BVK to give you more in detail what all are the operational efficiencies in OSAM that we have undertaken, which will help us improve our margins.
See, OSAM, when we have implemented SAP, a lot of infra correction we have done, a lot of stress is being given towards quality. and a lot of logistics cost. So everything, streamlined. So since, once we acquired, in a couple of months it took, maybe in the coming year, you will see further refining and a lot of operational efficiencies, some.
So what kind of time will it take for it to converge, and how does this, you're talking about now new land allocation and spending on that for expansion further in Bihar. So how does that affect the margin convergence trajectory?
So presently what we are looking at it is the land, because the government is giving that's only for a future project which will not be immediate, but more like we said, we'll have to go through the board approvals and get it. But existing operations improvement is still what we are looking at. We look at between 6 to 12 months will be that you will see all the improvements coming into effect fully, and then on it will come back to the regular margins as the overall company structure.
Thank you. Thanks. I'll fall back. Thank you.
Thank you. Next question is from the line of Yash Goenka from Africa Capital. Please go ahead.
Hi. Thank you for taking my question. My question is on the cycle. Do you see anything different about this current dairy cycle?
Hi, Yash. Yes, what we have seen is there's a significant, as usual, when the summers come in, we have seen a significant offtake in volumes increasing in the first quarter. That is one on the sales side, where we see the significant improvement happening in the product mix, giving a better realization over the previous last year, the same period. But on the other end, procurement was still under stress. We are seeing improvement signs, and we hope that maybe in another month or so, that will also start to improve. I think Maharashtra and Karnataka have improved a bit in terms of productivity. We are waiting to see how the productivity in Tamil Nadu, Andhra, and Telangana and other places will come into place. So the shift has happened in the proper manner in the sales side. Procurement is also on track. We hope to see better results coming in the next month or so.
Okay. Secondly, are cooperatives raising the prices in all the regions you're operating in the southern states?
They have increased the selling prices. Amul and Mother Dairy, as it came in the press, increased the 2 rupee selling prices. We have already taken the price increase in the month of March itself. Mid-March itself, we have taken the increase. So the cooperatives are just following the increase that we have taken to compensate the cost.
And over the next 2 to 3 months, would you be further taking price hikes, and what would that range be in?
We won't be taking price hikes per se, but we will be trying to correct certain things that are there, right? Like for example, if the packaging material, it will be only minor corrections that we will take, not a major price correction, because already we have a significant headroom over the cooperatives that are there. We will only correct more on the procurement side.
Okay. Lastly, just to confirm, you said that margins will be reverting to mean by FY28, right?
Yes.
Okay. Thank you.
Thank you. Next question is from the line of Abhishek Mathur from Systematics Group. Please go ahead.
Yes. Hi, sir. Thank you for the opportunity. I just wanted to check what is the milk procurement cost that you're seeing currently as of today? What is that level? And also with the pricing that you have taken so far, as of today, what part of the cost inflation is currently covered already as of mid-May? That's what I wanted to check first.
So Murli will answer that, Abhishek, but what you're saying is what is the price increase in procurement and what is the price increase in sales to have compensated the price increase, correct?
Yeah, broadly, yes, sir. Just wanted to check. So you gave the number for the procurement cost for the fourth quarter, but what is it today? And the pricing that we have taken so far, since we've indicated we are not planning any further major hikes, what part of inflation is covered as of now?
Yeah. Majority of the procurement price in line with whatever the March price is. There is no major increase. Okay. Whatever we provided as a consolidated 37.36 to 40.97, that is a 9.7 of growth was there year on year. The same thing is continuing. At a standalone, it is a 9.3%. Okay.
So we have passed on around, to answer your question, I think we have passed on around 1 rupee of the inflation in the sales recovery that we have already done, currently that we are doing. We are anticipating the procurement improves. We should get down another rupee or so will be coming down in the procurement price.
Great. So if I'm hearing correctly, as of mid-May, there is no sequential increase from the number that you gave out on the procurement cost front. Is that the right understanding to take?
Yes, that's the right understanding. No price reduction, but we are anticipating certain areas of price reduction to come effective in end May.
All right, sir. And second question is, for FY27, if you can indicate what is the capex that we are planning and what will be its breakup. I think you have given the FY26 to FY28 capex number, but for what will be that number for FY27? And also just some bookkeeping numbers, if you can share the console overall realizations and the VAP realizations for the fourth quarter. Yeah, that's it.
Yeah. So basically, regarding the, Murli will give you the numbers specifically about the capex up to the current year, and in the future capex that we are looking at, broadly it will be the highest number which will keep coming from Maharashtra, Assam and Africa business. I think Murli will give you the specifics in terms of what we are looking at our capex, and also the you wanted the fourth quarter numbers, right?
Yes.
Okay. Yeah. Both of them, FY26 fourth quarter numbers, we shall give it to you.
Yeah. Fourth quarter, what are the capex we have spent in?
So fourth quarter, you want the capex numbers or?
Capex we have spent around.
No, sir, I was asking for the capex number for FY27, and for the fourth quarter, just needed the console overall realization and the VAP realization.
Yeah. 1 minute, sir. So the fourth quarter console realization, sorry, you want to do the realization or the capital?
Budget.
Okay.
Okay. Overall budget for the FY27, what we have considered is,
1 minute, we're just filling up the number.
So what is?
Yeah, sure.
So 65 crores for the regular capex, what we consider. Around 33 crores we have considered for the CC. And hardware around 7 crores. And overall standalone we are expecting around 120 crores of capex. Q4, yeah, that's what we are projecting, Abhishek.
Without considering the Maharashtra project, which
Maharashtra, out of 280 crores, 20 crores we have spent in FY25, 86 crores we spend in FY26, and balance 100 crores, 180 crores we are planning to spend in FY27.
Those will be the broad areas of expense, capex that will be spending.
Right, sir. And the realization, sir?
So the fourth quarter realization for consolidated, I'll just give it to you.
Consolidated realization is 61.19. Okay, that is the overall sales realization of it, including the product mix. But if you exclude the.
And you want also the procurement price for fourth quarter, Abhishek?
No, so just needed the console realization and the VAP realization for the fourth quarter.
Okay. So for the milk procurement, we will talk about when you liquid, consolidated sales only. So it is 55.16 of last year, Q4 to, you said it is 56.16. But when you talk about specifically of India, 56.05 to 56.15 to 58.25. That is 2.10 increase in the milk sales realization, especially without the considering the VAP. VAP is a blended, so I can tell you the blended price. Basically at a standalone, it is 60.72, 60.892, it is reduced to 60.54 because the product mix was changed, because of the bulk sale we are exited. So that's why there is a reduction it shows in the, when you say the consolidated number.
Sorry, the VAP console realization was what, sir?
60.54.
Great. That's it from me. Thanks and all the best, sir.
Yes.
Thank you. Next question is from the line of Aditya from Securities Investment Management. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So I just wanted to understand what kind of price inflation we are seeing in our packaging and freight costs. So is it manageable now or it's going through the roof? And how are you looking to mitigate the same?
So I think packaging material as a number has gone up by 30%. Most of the plastics that are there, and we use a lot of the plastic, has gone up by 30%. That small corrections is what we have passed on to the consumers in terms of the price corrections that we have taken. So we are anticipating that the plastic prices will remain at the current elevated levels only because there was been some government support that came in the middle in terms of excise duty reduction and such. So unless something dramatic happens, we are thinking that it will hold fort at the current 30% increase over the previous year.
And so now with increasing petrol costs, how are you looking at our freight costs going forward?
So the current 3 rupees, I think, temporarily for a month or so, we will have to look at it and we will absorb, because a portion of it will be passed on to the transporters itself, because we take price corrections only periodically and we normally try to keep it for that period. And if it remains at 3, so that's the whole reason which I was saying, there's a certain uncertainty of times. We don't know whether it's going to remain at 3, is it going to go up to 6 or 7. So that is the reason we'll wait and watch, I think, for another at least fortnight or a month before we decide how to take it forward in terms of price.
Understood, sir. And now, sir, in such an inflationary scenario, is price increase the only solution for us, or there is an option for grammage reduction also in our kind of industry?
So grammage reduction, which we normally used to do, we will not do much this time, because it is not helping in terms of the consumers are also able to realize what is happening as grammage reduction towards price. I think it is going to be a blend today that we are going to do in terms of putting up procurement, operational efficiency, and marginal increase in pricing. It will be a blend of all the three. So for us, the way I look at it is we need to cover costs, and to improve margins, maybe we need to increase by rupee or so more in terms of pricing. If we are able to manage 30-40 paisa overall in procurement, 20-30 paisa operationally, and 20-30 paisa in terms of the front end, we should be able to improve our margin. And also because overall our volume growth is there, percentage might be a little on the lower side, but the absolute number will be higher, because the volumes in the first quarter are seeming to be pretty reasonable in terms of the size of the sales that we are getting.
Yes, sir. And now, sir, there is expectation of intense summer this season and El Nino. Now, in such a scenario, while we will be positively benefited because of higher VAP sales, but on the flip side, the milk yields might also take a hit, which would impact the procurement costs also. And with the milk inventory in the system pretty low, how do you see both of these things intermingling with each other and an impact on margins going forward? And what would be the factors, things you would look at going forward, which will give you the confidence of improving margin outlook for the company?
Broadly, like we said, the fluctuations will not be dramatic. If there is a severe drought, this is a two-way sword for us. Certain areas where there is a drought, animal husbandry improves because there is no other income for the farmers. They concentrate more on animal husbandry, and therefore production normally improves. And also the sales mix, if it continues to be high on the value-added product side because of higher summers, there is more curd, more buttermilk and lassi that goes up. Our average realization increases because of the product mix changing. So it sort of helps us in a manner of speaking to keep our costs going. So that is what we said. But we are more worried about the other costs that are going to shoot up dramatically more than the price of milk itself, right? None of us are certain about where will this price of fuel will be stopped. Because if you look at it when people, and this is my view, and please correct me if I'm wrong, $60 to $120 in my simple mathematics per barrel means it's a 100% price increase, which should translate even to a 25 or a 30% increase for us on fuel, which is not yet shown. So we are not sure whether it is going to go up by 20% of fuel or only going to remain at the current levels. So I think once we get more of a clarity on this, we can think of where on we are going to pass on. So how much to the customer, how much from the farmer, and how much in terms of operational efficiency.
Understood. Okay. And now, so if I have to understand now, when I look at your liquid milk sales volume, excluding Usam, so we have been growing at more than 9%. So just wanted to understand what would be the growth in India specifically, because Africa would be the major part driving growth. So just wanted to understand what is the liquid milk sales volume growth in India for the last 2-3 quarters.
So we will continue to grow with that volume terms of 5 to 6% in terms of liquid milk. Although in the current year we did, excluding bulk, including value added, we did 9.4% of growth. We think that we will continue to maintain an average growth in terms of including value added to the 10% of volume growth.
So what I wanted to understand was, we did not increase the milk prices because in the presentation you mentioned that you wanted to gain market share. So in the last 2-3 quarters, has our liquid milk sales volume growth seen an uptick?
Liquid milk volume I have seen an uptick, yes, and all, but value added we are pushing more. That has seen a significant uptick. Liquid milk has seen an uptake of around 5% to 6%, whereas value added has grown up by 16%.
Understood. Understood. And now, sir, what is the Osam revenue and EBITDA for this quarter?
For the fourth quarter of this year?
Yeah.
Yes.
Q4 EBITDA is basically 2.7 crore, and overall, they are talking about EBITDA. Okay, I'll talk about even revenue also. For the Q4, the revenue is 81.9 crore, EBITDA of 2.7 crore, and full year it is a 214.7 crore, and EBITDA is 4.8 crore.
Okay. And what kind of gross margins does Osam make?
Gross margins of Osam would be around 21%.
21.4.
Okay. Okay. And just the last one question.
The 25%.
Sorry, can you repeat, sir?
It will move up to the 25% soon.
And this will be majorly due to price hikes and improvement in that mix?
Yeah, price hikes, improvement in VAT mix, and also the efficiencies that we were talking about, increasing our own procurement, bringing down freight costs, cutting down on losses, and all that will help us.
Understood. Understood. And so just last one question. Now, in Orgafeed, we have seen a drop in margins. But what I understand that there has been a reduction in maize prices and margins should actually have improved. So what is the reason for this drop in margins in Orgafeed?
So basically, all those maize prices, I would say, that have reduced now, it will only be what we buy now will be used later. But I think the maize prices overall did go up and not come down. That is number one. And number two, earlier days, when you were operating in a closer proximity of our area, we had the advantage of other operating costs like freight. Now, since we're expanding our volume and expanding into other areas, we have impact on freight, and we have to be also competitive with the local producers. For example, if I'm sending my cattle feed to sell in Maharashtra, the transport cost from selling from Kuppam to Maharashtra will add on the margin pressure, and the pricing in Maharashtra in terms of the local competition will be there. But we're still maintaining that 11% margins that we are, and we think we'll continue to maintain that kind of margins.
Thanks, sir, for answering your questions. I'll go on back in the queue.
Thanks.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. We will take our next question from the line of Pradyumna Chaudhary from Bowhead India. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir. Yes, sir.
So my first question was on the butter prices. Last few quarters, due to elevated butter prices, is one of the reasons why we saw milk procurement price being higher. So what is the latest on the global butter prices and global SMP prices? And why were they really elevated previously?
So butter prices and powder prices are elevated because, like we said, last year was a low productivity in terms of milk availability coming down. And therefore, the stocks have been depleted, and only now in terms of this volume, stocks will be built up. That is the reason why we have removed our bulk sales and not done bulk sales, because we don't have the extra butter that we produce. But we have sort of compensated it by increasing our milk procurement that we have. And I think SMP we did turn out to be a small amount of a net buyer. And that is the reason why the whole market prices are elevated.
No, so my question was more on the global butter and SMP prices, not really India specific, because we saw a lot of butter exports.
Yeah, so global prices also in a similar manner. They are actually, I think, coming now, they are looking at it as an oversupply. And India's export of butter is not much. It's mostly ghee that we export in terms of fat for the Indian diaspora, which is there. That is what consumes more of the fat exports that India has.
So right now we are seeing these prices coming down, the export prices for butter and SMP?
No, not coming down. So they're maintaining the same state as what they were earlier. We are not much into exports. I don't have the specific numbers, but I don't think they're coming down.
But that's not a risk to our thesis that the milk procurement prices would start coming down. We do not expect that elevated global butter and SMP prices would be a risk to this?
Not much, because I think the number of exports that we see out of the country is not that significant to change pricing patterns. As much as also, and imports are very restricted because we have duty structure so that we don't get the flood of imports coming in. It will broadly be dependent on domestic consumption and production, not much of variation due to exports.
Understood. And the last question is on the COGS mix. If I were to look at a cost of goods sold for India business especially, so how much what would be the mix of that? Like how much would be milk as a percentage of your COGS? How much would be packaging material? What about logistics? If you can give that. And the second question would be on the Maharashtra side. I think we are procuring close to 2.5 LLPD already from Maharashtra, but we don't have any bulk sales as of this quarter. So where is it really going in terms of sales?
Sorry everyone for the disconnection. I just now, Murli will give the breakup of the cost that you had asked for earlier in the last question.
Overall, the consolidated, if you see the breakup for the full year, it is a 74%, which includes the packing material. And employee benefit expenses is around 4.9%, and transport cost is 7.3%, power and fuel is around 1.5%, consumption of stores is 1%, and balance all other miscellaneous expenditure. Other towards legal, traveling, rent, security, all those put together. So overall, the other expenses is coming to 13.2%, excluding the employment benefit expenses. That is 18.1%. Hope that
no. So actually, I think raw material.
Okay. So out of the 17.4%, 3.5% is the packing material.
Sorry, how much?
3.5%.
Is the packing expense. And what about logistics expense in this?
Logistics expenses, 7.3%.
And remaining else is all milk.
74% out of that, only packing material is 3.5 out of the 74, plus 7.3% transport.
And around 64 would be milk.
Yes. No.
74, transport is not excluded. 74.4 plus transport 7.3 you have to add for the transport
input and output.
Yeah. So transport includes the 4 legs, that is a village to the chilling center to the plant to the sales office to the customer. All the transports are included. Apart from that, the loading, unloading charges, the freight carry forward thing, and the contract labor who works under the transport of that.
All that comes to 7.3%. It doesn't come in the 74 of raw material. 74 of raw material includes 3.5% of packing.
And remaining is all milk, right? 74 minus 3.5.
Yeah.
And power and fuel would also.
Mr. Chaudhary, you may please rejoin the queue for more questions. Thank you. We will take our next question from the line of Asher from DT Portfolio Managers. Please go ahead.
Hello. Hi, Sandy. Hi, Murli. Hi, Sunny. Hi, Murli. I just wanted to know how are you thinking of the risk of El Nino on your gross margins? I think earlier in the call you referred to like a 50 to 100 basis points improvement in your gross margins. So how are you thinking of that?
Basically, we are very confident that milk procurement should come back normal. It cannot be there, and the prices will drop in milk procurement. And that itself should give us that difference in our margins. Because if you look at it as what we're saying as 1% or 100 bits of price margin, as you see, our average realizations are around 60 rupees. We're looking at a 60 paisa correction that we expect.
Yeah, that's fair. Thank you. And so my second question is a little more broad. Your Africa business seems to be going strong and like growing a lot. What is going right there, and how do you see that continuing into the future?
So I think what is growing right is basically Uganda, we have become a significantly large player, and in Kenya, we're just beginning to see that. And Kenya is a much larger market than Uganda. Earlier, we used to cater from Uganda to Kenya, and due to the border disputes, we were not able to cater to it properly because there would be restrictions on how much we could send. Once we have now entered in Kenya with our own operations and our own plant and having a stability of the product, we are able to do better. And I think in terms of comparison, like we said, it's more keeping your quality in the improved quality, making sure that operational efficiencies are maintained. And we are still a smaller market share in Kenya, and that gives us growth opportunities. And like you said, in Uganda, we are expanding. Earlier, we were into long life products only. Now we are entering into the pasteurized and other milk products.
Okay, perfect. Thank you.
Thank you. Next question is from the line of Darshan from Asit C. Mehta Institutional Equities. Please go ahead.
Yeah, hello.
Sir, you're audible. You may please proceed.
Thanks for the opportunity. And I actually firstly just wanted curd sales in rupee terms for this quarter, Q4.
The curd sales Q4 in rupee terms, right, Darshan?
Yes.
Consolidated curd sales for the Q4 in rupee terms, 230 crore, and for the full year it is 845.7 crore.
All right. And secondly, just wanted to understand, is there any considerable difference between procurement and realization, cost and realizations between domestic overall business and OSAM? And if we were to just see a broader trend, do they move in tandem or are there certain gaps between the trends?
Okay. So I was not able to get the question clearly, but what you're saying is the difference between OSAM price realization and the rest of India price realization. Am I correct?
Yes.
So actually,
yes,
OSAM in fact has a better realization than in the VAT portion than in here. Murli will give you the specific numbers.
So with regard to Dodla Dairy India, so basically the milk realization is around 58.1, and whereas HR Foods, that is OSAM, it is 55.7. And VAT, excluding the fat product, it is 64.2 for the Dodla Dairy, whereas for HR Foods, it is 98.8.
Okay, got it. All right. Yeah, I'll get back to you.
Thank you.
Thank you. Next question is from the line of Deepak from Unifi Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. Congrats on good top line growth, but my questions were on the margin profile of the company. Sir, if you can explain as to how you will get to the 100 to 50 basis margin expansion that you're talking about in EBITDA for FY27, given that procurement costs are still elevated at the March levels, freight costs are up, employee and other expenses are also, the costs are up by anywhere around 15 to 20%. So if you can explain, firstly, the gross margin trajectory that we should start looking at from Q1, and then the below gross margin line items that is under your control, employee and other expenses as well. So yeah, I would like to hear your strategy on that.
So you're right, Deepak. Basically, the employment expenses this year, we actually brought it down in terms of the existing operational by only a 5%, 6% increase, but the overall impact is still at 11% because of the new wage code impact that is there. All these costs, including packaging that you're looking at and all that would have taken up our cost by maybe a rupee and a half. We are expecting that the procurement prices should come down to the rupee and a half to 2. And because of the product mix improvement, our realization is on the higher side. As a combination of these two, that, like I explained earlier, our 100%, 1% increase represents roughly a 1 rupee, 1.5 rupee of price overall efficiency that we need to build up, which we think will come once in the following quarters, because normally price will come down. It will not come down for 1.5 years. It will come down as productivity increases.
Okay. So if I hear you right, so are there any structural circumstances which occur in the May month or the June month, which would lead to this price reduction? And I don't understand as to why
because
the
already
procurement cost
Maharashtra
would...
and Karnataka have got a significant upward growth in the milk procurement. So you will start seeing, Maharashtra prices sort of correcting a little bit to, because of the growth that is coming in. And similarly, when the seasons of the rest of the operations come in, you will see a drop.
Sure. So, next thing I wanted to understand on the price hikes, your strategy on not taking more price hikes when you have the opportunity as the cooperative is also taking. So I just wanted to understand your mindset on taking more price hikes. Maybe you're not taking it right now. Will you take it later in the future? I just wanted to understand on the pricing action from the company.
Because we have basically taken a price hike in March, which the cooperatives have only followed later now in May. So we will again take, the next round will be, as I said, the uncertainty of the fuel prices, packing material and all that has to settle down. And once we see what the impact of that is going to be in terms of sort of a stable state, then the price hikes will again come in from all of us. It's only now that the difference in terms of us and the cooperatives are significantly higher. We don't want to keep expanding that more and more.
Okay. And lastly, on the volume growth for both the liquid milk and VAP, you mentioned that VAP had some operational challenge. So if you can allude to what operational challenge, and secondly, what kind of growth have you seen to the season which has started in April? So if you can call out that. And any improvement that you've seen in the growth rates for milk, sir?
Yes, our milk growth rates have maintained around that 4.5% even in the current the scenario, but we have seen significant increase in the VAP growth. Like we normally say that our summers of VAP will be higher. So our VAP growth rates have been significantly higher. We are around 16-17% VAP growth.
Okay. And sir, if you can...
I'm sorry to interrupt, Deepak. I'm really sorry. You may please rejoin the queue for more questions. Thank you. Next question is from the line of Rehan Bakri from Umayya Advisors. Please go ahead.
Yeah. Hi. Am I audible?
Yes, sir.
Yeah. So my first question is regarding the impact of an increase in fuel price by 1 rupee on the logistic cost.
So basically, when you look at fuel prices, the 3 rupee increase currently will have an impact of us on maybe, not as that much in terms of 0.5% is what the impact would be. But that, as I said, if we delay giving it to our transporters, normally they take a hit for a 15-day process and then we go in. So currently it will only be a small hit of 0.25% that we look at. But once we are sure of what the fuel prices are going to be stable at, then we can make a call of how to pass it on.
Okay. And my second question is regarding the Africa business and what can be the sustainable growth number to look for there?
The sustainable growth numbers in terms of volume, we are confident of maintaining the 20% kind of growth numbers in the current year.
Okay.
Vihan, does that answer your question?
Yeah, actually I wanted to know the value as well in terms of the sustainable growth.
In terms of value, you mean, sir?
So basically, sir, last year we done around 500 crores on that. What are you talking about?
20%.
20%.
600 crores.
That is the guiding number.
Well, yeah. Okay. That answers my question. Thank you.
Thank you. Next question is from the line of Aniket Shah from White Equity Investment. Please go ahead.
Thank you for taking my question. Sir, regarding the Africa sales, can you split it between Uganda and Kenya for F25 and F26, please?
So Uganda and Kenya break up for 25 and 26, is it? 1 minute. BBK will answer this.
Uganda is almost stable, 1.45 to 1.5 lakh. So, see now, if you see last year we have done, FY25 180, 1,80,000. Out of that, 1,45,000 from Uganda and balance, 35,000 from Kenya. And FY26, the similar number, from Uganda we have done 145, 150, And the total number what we have done average is 227. 227. So 227, so 150,000 minus balance 87, 90,000 liters average we have done in Kenya. FY26.
So yes. So F26 volume growth has largely come from the Kenya piece.
Yes.
Okay.
Yes.
And sir, if you can give the Africa EBITDA numbers, we have the revenue numbers, but F25, F26 and Q4 F25,
Yeah.
Africa
EBITDA number. Yeah. Yes. The EBITDA number, in 25 it was 11% EBITDA, and 26 is 11.3% EBITDA.
Okay. And sir, the last question I have is on the Maharashtra plant. So where are we on the procurement in Maharashtra in terms of lakh liters per day? And do we see it going to 5 lakhs till end of 27?
So right now, the average procurement in Maharashtra, what we are procuring is 3 lakhs average right now.
3 lakhs.
Last couple of months onwards. So once season comes, by end of this year, we are targeting, minimum 5 lakhs.
Yes. Okay. Thank you for taking my question.
Thank you.
Thank you. That was the last question for today. I would now like to hand the conference back to the management for closing comments.
Thank you everyone for joining us today on this earnings call. We appreciate your interest in Dodla Dairy. If you have any further queries, please contact SGA or Investor Relations Office. Thank you very much.
Thank you. On behalf of Dodla Dairy Limited, that concludes this conference. Thank you all for joining us today, and you may now disconnect your lines.
Thank you all.